Welcome students to our last module of the course. In this module we leave the WACC, discount rates and capital structure policy alone and start talking about dividends because most of the times that's what makes investors buy shares in a company. The cash flows, the dividends, the return to investors is quite attractive and that's why people invest in shares. In this module we discuss dividends and dividend policy as they are an important part in the life of the company. This is the third area of corporate finance, the dividend decision. Depending whether a firm will pay dividends or not, it will have an influence on how the market and investors value the share of such company. Therefore, in this module we look at cash dividend types, how they are paid, and measures of dividend policy. We investigate the issues surrounding the dividend policy decisions in the sense that we ask the question, is it better to have a higher dividend or a lower dividend? Is it better to pay cash dividends or repurchase shares? Should the firm pay a dividend to its shareholders or instead with the money invest in projects and ultimately increase the shareholders' value? Essentially, the firm has three decisions with respect to its earnings in a given year. Number one, reinvest the earning as internal equity in the business. Number two, pay the earnings out to shareholders in the form of dividends. And number three, repurchase outstanding shares. Does it matter which of these policies the firm adopts? In theory, we will see that it is irrelevant. However, in reality, most firms undertake a combination of all three. This decision is important because it determines what funds flow to investors and what funds are retained for the purpose of investment in the firm. So there is an interrelationship between a firm's financing and investment decisions. It is a complex decision as it depends on real-world factors like taxes, transaction costs, and shareholders' preferences. Back in 2010, a couple of years after the GFC hit, companies started to bounce back, announcing big profits following improved consumer and investor confidence. These higher earnings led to firms paying high dividends as well, some of them for the very first time too. Starbucks was such a company which after 2 years of hardship recovered well enough to pay their very first dividend in 2010. The term dividends refer to cash paid out of earnings. If a dividend is made from other sources than retained earnings, we use the term distribution rather than dividends. As cash dividends, we have ordinary dividends. Australian listed companies pay dividends twice a year, usually as an interim dividend and a final dividend. However, companies are not limited to pay twice a year and may pay more or less frequently. Then we have special dividends, typically used when the company wants to make a one-off payment, often found in cyclical industries or when substantial assets are disposed of, as in a liquidating dividend. It enables firms to pay a low stable dividend and increase when times are good. Shareholders like the stability of ordinary dividend and are pleased when the firm pays a one-off special dividend. The firm can reward the shareholders by paying special dividends without altering the long-term dividend policy. And then there are share repurchases or buybacks. Happens when a company buys its own shares from investors using corporate cash, which is the same as a cash dividend. The non-cash dividends are in the form of dividend reinvestment plans. This allows shareholders to receive new shares instead of cash. For shareholders, the advantage is that these shares are often issued at a discount and no brokerage or stamp duty is paid. Thus, the firm retains cash and at the same time accumulates equity capital cheaper than having to pay for a new share issues in the market. Then we have share dividends. These are paid when shareholders elect to receive all or a portion of their dividend in shares instead of cash, also known as a bonus share issue. And it's expressed as a percentage, and it's applied to the number of shares already held by the investor. And last, we have share splits, which are similar to share dividends, where company issues shares to existing shareholders based on their current level of ownership, and it is expressed as a ratio, for example, a 3-for-1 split. The decision to pay a dividend rests with the board of directors. They have a meeting, and if they decide, okay, let's pay the dividend, they make it official and announce it. Once a dividend has been announced, it becomes a liability to the firm and it must be paid. After the declaration date, a next dividend date is set by the brokerage firms and exchanges for the purpose of establishing the individuals entitled to the dividend. Shares are bought and sold every day. This ex-dividend date acts like a cut-off date. If you buy a share that has a dividend declared before the ex-dividend date, you receive the dividend. If you buy the share on or after the ex-dividend date, you don't receive the dividend. It goes to the previous owner. Usually this date is 4 business days, not calendar days, before the date of record. In the United States, the ex-dividend date is 2 business days before the record date. In other countries, it might differ as well. In general, on this date, the price of the share drops by the amount of dividend to reflect the fact that the individuals purchasing the share don't have the dividend attached. The date of record is when the company prepares the list of shareholders in the books for the purpose of writing the checks, and the date of payment is the date when checks are mailed. This table displays the Big Four banks' dividend amounts for 3 consecutive periods during the 2012 and 2013 financial years, together with the relevant dates surrounding the dividend, what type it is, and whether it's franked or not. Commonwealth Bank has the highest dividend, followed by the National Australia Bank, Westpac, and ANZ. All of them pay dividends twice a year, which are fully franked, meaning that full tax has been paid by the company already. When it comes to dividends and dividend policy, investors and analysts are interested in 2 measures. One of them is dividend payout, which measures the proportion of earnings that the company pays in dividend, and the dividend yield, which measures the return received from dividends alone, which together with the capital gains yield may make up the return on an investment. In Australia, companies have a focus on cash dividends. Most industrial firms in Australia pay either fully or partially franked dividends. Currently, the yield on the Australian market is around 4.45%. Typically, the resources sector has a lower dividend yield because of the focus on reinvestment and capital growth. Some companies declare a dividend policy. However, until 1989, Australian companies were prohibited from undertaking share buybacks. This was changed in 1995. However, the law governing buybacks is still very rigid compared to the US. A recent example of an off-market buyback is Woolworths Limited. As of January 2015, the Australian dividend yield was 4.45% in comparison with the rest of the world, which sits at just over 2%. These are some of the types of dividend policies that companies adopt. The constant payout policy pays the same percentage of earnings each year. This policy depends on the earnings of the firm, because if earnings are low in one year, the dividends will be low as well, and vice versa. and this will result in a volatile dividend payment. The constant nominal payment policy ensures a fixed dollar dividend each period, thus avoiding dividend volatility. With this policy, the firm increases the amount of dividend only if the sure expected earnings can support these high payments, and never cut the dividends unless a disaster happens. The reason is that dividends convey signals to the market. This will be discussed later in the module. In some cases, companies offer a low regular dividend payment, which ensures continuity of income to investors without giving them false hopes, and also provides stability in the market with respect of signals. Then rather pay a special or extra dividend when earnings are higher than normal. As we mentioned, the company can pay dividends in the forms of shares instead of cash dividend. This payment causes an increase in the number of shares outstanding, diluting or reducing the value of each share. They are also known as bonus issues. Usually a share dividend is expressed as a percentage and is applied to the individual share ownership. For example, if an investor owns 100 shares already and a share dividend of 10% is declared, the investor will receive 10 shares, totaling 110. So to find out the new number of shares, we take the old shares and multiply by 1.10. To find out the new price per share, we take the old price and divide by 1.10. Shareholders receiving the share dividends maintain a constant proportional share in the company's equity, and the net effect on their wealth is neutral, as shown in the example. Before the share dividend, the investor had $3,000 in wealth based on 100 shares at $30 each. After the share dividend, investor still has $3,000 based on 110 shares, but at a lower price at $27.27 each. Supporters of share dividends argue that sometimes a share reaches a price that is too high to be traded by common investors. Issuing share dividends reduces the value of the share to an optimal trading range. Not only is the share more affordable, it also avoids odd lot transactions and helps the share become more widely held. Stock splits is the same as a share dividend expressed as a ratio. As with the stock dividend, the share price is reduced proportionally, and the argument for doing it is that it brings the share price within a more affordable trading range. To use our earlier example of an investor owning 100 shares at $30 each and a total value of $3,000, a 2-for-1 split means that for 100 shares that the investor owns, he will receive another 100 shares. So for one share that he has, he gets one more, ending up with 2, which is similar to a 100% share dividend. So we have a new number of shares higher than the previous number, and the new price which is lower than the original price. What about if the same investor goes through a 3-for-2 stock split? For every 2 shares owned, the investor will receive another one. So 3 minus 2, 1 additional share. So what is the number of new shares and what is the new price? We apply the formulas presented, and again the new shares, the new number of shares are 150 shares, and the new price is $20. Remember, with the share split, the number of shares outstanding increases and the prices gets diluted or decreases. An alternative method used by companies to pay out a firm's earnings to shareholders is to repurchase their own shares. Share buybacks indicate that the company perceives their stock to be undervalued. By repurchasing their shares, the value of the remaining shares increase as earnings are split among fewer shares outstanding. Share repurchase is also known as share buybacks and is usually done when the company has surplus cash and are subject to Corporations Act and the ASX rules. Generally, companies are able to purchase about 10% of their ordinary shares in a 12-month period. There are 5 types of buybacks. Equal access purchase, where all shareholders are invited to sell to the company directly. On-market purchases, where is a purchase by a company of its own shares on the open market. Employee share purchase, we purchase shares from employees that were issued under Employee Incentive Scheme previously. And then we have selective purchase, where the company repurchases shares from specific shareholders. And odd lot purchases, where the company repurchases small parcels of shares. Share buybacks are similar to cash dividend, and in a perfect world, investors' wealth is unchanged. However, in a world with taxes, share repurchases implies that they enhance shareholders' value, perhaps because the difference in the capital gains and will be deferred and the tax on cash which has to be paid when received. The practical motives for share repurchases include obtaining shares to be used in acquisitions and having shares available for employee share options plans. We've seen that paying dividends matter because it affects the value of the share. Remember how we value a share: present value of all future dividends. If there are no dividends, the value of the share will only be based on capital gains. Now, the next discussion is about the dividend policy. And we will see that in a perfect world, it is irrelevant because it doesn't change the value of the firm. Dividend policy is just the time pattern of dividend payments. The decision to pay larger dividends versus paying smaller dividends and retaining funds to reinvest in the firm, or pay cash dividends versus repurchasing shares. The reason it doesn't matter is that if the firm pays low dividends today, it reinvests more capital, grows faster, and pays larger dividends in later years. Or on the other hand, if the firm has higher payout ratio now, it will reinvest less capital back into the firm, therefore lower earnings later and lower dividends. This irrelevance theory proposed by Modigliani and Miller has a few strict assumptions such as no company taxes, no transaction costs or market imperfections, no personal taxes, and a fixed capital budgeting program. Miller and Modigliani, M&M, showed that dividend policy cannot impact company value in a world without market frictions. They showed that dividend policy was irrelevant in the same way they proved that capital structure was irrelevant, in the absence of no costs and no taxes. The theory suggests that the value of a firm is determined by the future cash flows of the firm's assets, the earnings, and the shareholders don't care how these earnings are split between dividends and retained earnings. Value derives solely from the inherent profitability of the company's assets and the competence of its management teams. And if investors are not happy with the company's dividend policy, they can create their own homemade dividends to mimic the desired policy by selling shares or reinvest excess funds. If, for example, the firm increases dividends and everything else stays the same level of reinvestment, then yes, dividend policy matter. For example, we have a firm called Payout with assets worth 20 million and expected cash flows are $2 million next year. There is an opportunity to invest in a project all these $2 million of cash flows. Now it has 1 million shares outstanding at a value of $20 per share. The shareholders' required rate of return is 10%. Payout decides to pay out all if its cash flows as dividends, which means there is nothing left in the retained earnings to undergo the investment or the project. Therefore, they need to raise $2 million worth of funds by issuing 100,000 shares at $20 each. We observe that after paying the dividend and raising funds, the value of the firm is $22 million. Shareholders earn the required return only from the dividend received as the dividend yield. The share hasn't gained in value, so there is no capital gain. So that 10% is just the dividend yield. $2 divided by $20, the share price. Now we have another firm which we call it retain, with the same assets, cash flows, investment opportunity, and shares outstanding and prices. But retained company chooses to keep the $2 million in cash flows and invest those money in the project and pays no dividend. We observe that by paying no dividend and retaining all funds in the firm, its value is $22 million. And the shareholders earn their 10% again, required return, which now is made up of capital gain only, because there is no dividend and the share price has increased from $20 to $22. So therefore, the 10% is made of the change in the dollar value of share divided by the original price per share. As proposed by Modigliani and Miller, in a perfect world, dividend policy does not matter, because as our example has shown, regardless of the dividend policy, the value of both companies is the same. The value of the firm only depends on the investment it undertook.